All right, let's talk about inflation. Let's talk about inflation in the United States and tell you why it's a concern, not just for global markets, not just for US markets, not just for investors, but actually for the world, because it's in a sense a symbol of a problem that several nations across the world are facing. And as we continue into a state where we're more and more interconnected, where supply chains crisscross across the globe, it's going to be very difficult to escape what we are seeing in the United States. First, let me take you through what's happening in the US markets. They had a bad knock yesterday after consumer inflation in the United States clocked in at 6.2%, the highest in 30 years, over 30 years, but a smart recovery today and stabilizing of sorts. The Dow Jones right now, though, in the red and 90 points down, but just 0.25% down. Nasdaq up in the green at up about 0.5%, as is the S&P 500, flattish to positive, just about 5 points up. Now, the question that we're asking today is, does this inflation really look transient, as the Federal Reserve had said? And can this be an issue that we're stuck with well into next year? Peter Cardillo and Geoff are with me right now to speak more on this. Peter, welcome to the show. Let me begin with your take.
Well, look, I don't think that inflation is transitory. We've been saying this now for at least 6-7 months, and I think that, of course, in part it is, but basically there is structural inflation now that's taking place here in the United States. We see that with rents. We see that with wages. We see that with insurance premiums that are going up, and so and car prices that are going up. So the Fed has a problem here, and I think inflation is going to last right probably into the second quarter of 2022. The problem is that the Fed needs to act and act now. So they already announced tapering, but my guess is that probably they're going to have to alter their tapering levels by perhaps doubling them and begin to look to change monetary policy sometime in the beginning of the third quarter.
Geoff, the issue is that it's beginning to bite people. It's becoming, I guess, a politically volatile issue as well in the United States. Joe Biden is under pressure to address it. What is the kind of action you see happening?
Well, Biden can't do very much about this in the short term. I mean, it's not, in fact, he can't do very much about it, period. This is not an issue which can be dealt with by presidential edict or indeed by presidential action. I agree with almost everything Peter said, by the way, in fact, everything he said. I would simply add the following, and that is the signs that this is turning from transitory into something more structural would also include, as far as I was concerned, the sharp jump in wages now, shortages of labor for sure, which people are puzzled about, but sharp jump in wages, which means you end up with some sort of a wage price spiral, which is, not like it was in the 1970s, but it's still disturbing. And also clear signs that inflation expectations are building as well. So I'm with Peter entirely. The Fed has got to move here. And I got to believe that they will accelerate the tapering process and possibly also bring forward an interest rate increase until, who knows, first quarter of next year maybe. Because they've got to react to this in some way. Real rates are -6, which is kind of ridiculous as far as I'm concerned. Therefore, sorry, to answer your question directly, the organization that can really help us deal with inflation in the long term is the Federal Reserve, and monetary policy is too relaxed. So Biden's taking the heat. He can't do much about it. Fed's got to move.
Siddhartha Sanyal also with us. He's the Chief Economist and Head of Research at Bandhan Bank. Mr. Sanyal, thank you so much for joining us this evening. Now, that's what's concerning domestic markets and investors, isn't it? That the Federal Reserve will have to push the accelerator on interest rate hikes sooner than later in the face of such red hot and sticky inflation. And that is going to impact us. It's going to impact funds flowing into India, and foreign investors are possibly going to withdraw.
Yeah, very, very true, Tamanna. If you see today, financial markets as well as economies are far more integrated than what they used to be earlier. So if there is a rate action on the part of the Fed, that will have impact both on our economy as well as on more directly on the financial markets for sure. Now, what is interesting, that the other part is whether it will be limited to impacting only investor sentiment, foreign flows, or it will be having a direct consequence on India's monetary policy and rate trajectory. My sense is that there we might still be having some buffer, because RBI in 2020 had been much more nuanced in terms of lowering the rates. So they can, there is not a dying hurry on their part to hike rates. However, they have also started withdrawing liquidity in a very significant way, and that we have seen in the previous policy. I think that particular policy will continue, but they might not be in a rush to hike rates on that particular part. The Indian Central Bank might opt to stay slightly behind the curve, and that may not be a bad strategy at this moment of initial stage of recovery.
Now, let me just broaden the horizon there, Mr. Sanyal. Now, I started this discussion talking about why the world should be worried about what is happening in the United States. Explain to us why this could turn into a problem.
Oh, well, if you see even Indian inflation, which are the major drivers? The major drivers are either food items, which is the price movements are very global in nature, apart from some local weather disruptions, etc., etc. Food is a big component which is global. Metals is a big component which is global. Energy is a huge component which is global. So if there is pressure on the global inflation front, there will obviously be pressure on domestic. Inflations are not in watertight compartments anymore. And also service inflation expectation, everything get fed over a period of time. Maybe there might be a bit of a lead and lag, but definitely there will be impacts, and that is what we are seeing at this moment. Maybe the last 1 or 2 months, we have seen a little bit of relief in terms of slightly softer than expected numbers, but by and large, inflation had been surprising on the higher side for a while, even in India.
Yeah. Let's talk about when we say, so we all agree this is not transitory. This is here to stay. The reasons for it are surprisingly positive, right? The reasons for it is because of the pandemic, people couldn't restock, producers couldn't restock. They expected a dampening of demand for a longer time. But as vaccination spread fast enough and infections started coming down, we figured faster than expected on how to deal with it. Demand just jumped. And the world is just not able to keep up with it. So at the root of this, it sounds like good news fueling this inflation. Now, my question to you, Geoff, is for how long do you expect the pain to last? How much time will it take for the world to sort of get back on its feet in terms of supply chains?
Well, that's a complex question. I suspect it'll take at least another 6 to 9, maybe 12 months, because there will always be certain bottlenecks that will not all go away at the same time. Meanwhile, as you rightly say, this has been a demand versus supply situation because of the surprise with the speed with which demand has picked up post the pandemic. But it's the other thing that is really causing this inflation, in my opinion, to become more dangerous and more difficult to deal with is the apparent labor shortages at higher unemployment rates than we saw pre-pandemic, and that's pushing wages up. The stories are legion in this country, in the US, of companies offering higher wages to attract workers. And if I can just step in, if you forgive me, and just step into the Indian environment or the emerging market environment generally, the other factor that's really hurting EM from this inflation move that we're getting in the US, which we shouldn't overdo. It's 6%. It's not like it's 10 or 15%. The other factor is that, of course, the dollar's strong, and that's bringing in exchange rates down, and that's already led, including in India, to certain emerging market central banks, 8 or 10 of them actually raising rates already. So they're building some protection there. But I think this whole thing is going to take at least 9 to 12 months to play itself out for inflation to get back to a more reasonable level in the US. And that's why I think the Fed is way behind the curve and needs to act pretty quickly.
Yeah. Peter, any timeline that you want to share? Geoff says 9 to 12 months before this eases. He's also talking about the pain that emerging markets are going to face as the dollar continues to strengthen. Your take?
Well, I think, as far as the bottlenecks are concerned, probably we're looking towards the latter part of the second quarter. We should begin to see some relief in that debacle. But as far as the dollar is concerned, I had a 0.95 target by the end of the year. Obviously, we reached it 6 to 7 weeks before that. And based on the fact that inflation is so high, the markets are now indicating that the Fed is likely to do something earlier than expected. And so that's going to drive in more dollar investments in the United States. And that means that the dollar probably could strengthen even further. To what degree, I'm not sure at this time, but based on the dollar index, there's a good possibility that we could see 96, 97. And that would probably, the stronger dollar obviously would help here in the States in the sense that it would limit import inflation. But the problem is that we're exporting inflation. And so from that perspective, the stronger dollar might actually be a negative in terms of economic activity in the States.
Yeah, absolutely. We'll have to wait and see how this impacts India. Well, one relieving factor for India in terms of actual inflation, and right now the numbers, the headline numbers don't look too bad. We're about 4.2 on CPI on retail inflation. Core inflation is a little higher, and that is hurting. But excise duties have been cut on petrol and diesel. Several states, most states have followed with a cut on VAT as well. So that very basic propeller of inflation here has eased off. We'll have to see how far that goes. We read a story today on ET Now about how apparels, for example, are going to cost you more by about 20 to 25% in India in the next 3 months, just because the price of cotton and yarn have gone up so high. So that is the kind of inflation that we will have to deal with. Thank you so much to all of you for joining us today on the show.